Hello and welcome to this video on liquidity ratios and the statement of financial position.
Now, do you, like me, ever wake up in the middle of the night and wonder just how much you're worth? Well, to answer this question, you might think about all the things that you own and then consider all the things that you owe. So let's consider the things you own. Say you own a flat, or you own money in your bank account, or you're owed a tax refund from the taxman. These would all be positive items that would increase your worth. But then you have to compare them to things that you owe. So maybe you owe the bank a mortgage you used to buy the flat. Or perhaps you have an overdraft. At some point in the future, you're going to need to pay that money back. Or perhaps you're thinking about this on your sofa, but you haven't yet paid for that sofa. And so in future, you're going to have to pay that money out. So that is money that you owe. So in your mind, you might calculate all the things you own and subtract all the things you owe and come up with an idea of what your financial self-worth is. And then in my situation, you wouldn't be worth very much. It's exactly the same concept for a business. They will want to look at exactly how much they're worth, and businesses call this a statement of financial position. And the things they own, they call assets, and the things they owe, they call liabilities. And that's what we're going to look at in this video. We're going to look at what a statement of financial position shows. We're going to look at this term liquidity and how businesses can measure their liquidity. And then finally focus on the cycle of working capital. So far we've looked at two records of financial performance. We looked at a statement of comprehensive income, which showed us revenue, cost and profit. And we've looked at cash flow, which showed us the cash inflows and outflows of a business over a period of time. In this video, we're looking at a statement of financial position. This is a snapshot of the business's assets and liabilities at a particular point in time, maybe a particular day, usually the last day of the financial. And that's an important definition we should take down in our notes. Often, you'll see a statement of financial position described as a balance sheet. And a balance sheet shows all the assets of a business, all the liabilities of a business, and therefore the worth, the final worth of a business. Now, to introduce this concept, there are some key terms that we have to be confident with and familiar with and be able to use. The first set of key terms is to do with assets. And assets are items of value owned by a business. And there are two broad categories of assets that we need to be aware of. The first are non-current assets. And those are assets that are likely to be kept by the business for more than 1 year. So for example, vehicles the business owns, or its own premises, or any machinery, these are assets the business is likely to keep for more than a year. They're not going to get rid of them currently, so they are non-current. They're going to be here for a long time. The second category of asset is called current assets, and these are assets that are likely to, within a year, be turned into cash. So for example, stock. For most businesses, their stock within a year will be sold for cash, and so we'd classify that as a current asset. Now this second one here is a good one to pay attention to, trade receivables or debtors. This is money that is owed to the business from customers who haven't yet paid. So let's imagine the business allows their customers 2 months to pay up for an item that they've purchased. Then this money that is owed would be counted as an asset. It's money the business is owed from customers, so they are in debt to that business. So we call that debtors or sometimes trade receivables. The final asset that is likely to be turned into cash within a year is, well, cash. If the business has cash in the bank, this is a current asset and would be shown as such on the statement of financial position. The next category is liabilities. Liabilities are the money a business owes, for example, its debts. And again, we have two categories. The first being non-current liabilities, so the debts that the business has more than 1 year to repay. For example, a long-term bank loan, maybe it's got 15 years to pay that. That's non-current. It doesn't have to be paid currently within a year. It's non-current. They have more than a year to pay it. And the second category is current liabilities, debts the business has to pay within 1 year. For example, an overdraft. A lot of overdrafts, the terms are you have to pay them off over a short period of time within 1 year. So that would be a liability, something they owe that is current. Again, creditors, kind of the opposite of debtors here. Let's say the business has received supplies from its supplier, but it hasn't yet paid them. That is money they are liable for, as money they owe, and it's as if the supplier has extended credit to them, given them credit a period of time to pay. The final term we will see is capital or equity, and that is money put in by the owners or the owner's shareholders' worth. So there's two categories here, two key terms we need to be aware of. First one is equity, that is money put into the business by shareholders, sometimes called share capital. And the second one is retained profit, and that is money that has been reinvested from previous profits the business has made. So we have a lot of key terms here to understand the statement of financial position, and these are quite technical terms. So it's worth making sure you have all these down accurately and you've spent a little bit of time just looking through them before we continue with this video. So here's an example of a statement of financial position for 2015, and we can see here are the assets. So long-term assets, assets that will be around for more than a year, not converted into cash, £19,550. Current assets, assets that are likely to be turned into cash within a year, £5,845. If you add those two together, we'd have all the assets, total assets. Then we've got liabilities, short-term liabilities, debts within 1 year, 8,160, and debts that don't need to pay within 1 year, 6,000. So if we take all the assets and subtract all the liabilities, we get what's known as net assets or net worth. So in this example, the business is worth £11,235. That's what they own, subtract what they owe. So the business is worth £11,235. So the shareholders, the owners, they are worth, in terms of the business, £11,235 as well. And you can see that's come from £7,000 they've invested in shares and £4,235 that has been reinvested in the business, re-spent on assets from previous profits. So you'll notice here that the net assets and the total equity are the same. They balance, and that is why this is commonly called a balance sheet. So let's look at that now. Why does the balance sheet balance? Well, the assets of a business are always going to be equal to the liabilities, the money owed, and what the shareholders have put in, the capital. Let's look at a quick example to illustrate this. Imagine the business has one asset, a football ground, for example, very fine football ground there, and it's worth £5 million. Now, where has this money come from? Some of this money may have come from a bank, say a bank loan of £3 million. Now, this would be a liability of £3 million. So where must the rest have come? Well, the rest must have come from shareholders who've invested in the business, the £2 million. So the assets, £5 million, would be provided by the £3 million liability and the £2 million shareholders' capital. So if we take this a step further, we can say that net assets, the worth of the business, remembering that net assets is assets minus liabilities, would equal the capital or the equity that is belonging to the shareholders. So just to continue our example, the net assets would be the asset, £5 million, minus the liability, the £3 million. So the net assets are worth £2 million. And if we remember how much did the shareholders invest in our example, well, they invested £2 million. So the net assets will always equal the shareholders' funds or the equity capital belonging to shareholders. And that is why our balance sheet balances. And here we can see the net assets, 11,235, equal the equity belonging to the shareholders, 11,235. So we have done our first objective, looking at what a financial statement of financial position shows. The next objective is to look at liquidity. Liquidity measures a firm's ability to meet short-term debts and day-to-day expenses. So it's to do with cash, to do with the ability to pay debts and run your business from day to day. As we said previously, cash is an important consideration for a business to keep going from day to day. So liquidity measures a firm's ability to do this. And we're going to look at two ratios that a business might use to measure their liquidity. Before we do that, we need to introduce this concept here. It's this final key term of liquid assets. Now a liquid asset is like a current asset but doesn't include inventory, doesn't include stock, because this is deemed the hardest of the current assets to turn into cash. So we don't include it as kind of cash. We do include cash, obviously, that they've got in the bank, and receivable, debtors, money the business is owed. So this is liquid assets, receivables plus cash. And so we're going to look at two ratios here to measure how well a business, or how able a business might be to pay any short-term debts that are arising. And that is the current ratio and the acid test ratio. The current ratio is the current assets divided by the current liabilities. This is an important formula that we should take down in our notes. So let's have a look at an example. The current assets, the assets the business owns that can be turned into cash within 1 year, including stock, are 6.9 million. And the current liabilities, the money the business owes, the debts have to repay within 1 year, is 3.7 million. So what would be their current ratio? Well, 1.85 to 1, or 1.85 would be the solution here. And what does that mean? It means for every £1 the business owes or has to repay in the next year, they have £1.85 of assets to cover that within the next year. So what does this mean? How might we evaluate the current ratio? Well, in terms of interpreting the results, anything between 1.5 and 2 would suggest the business has an efficient level of cash, what we're later going to look at as being working capital, to meet the requirements of the business. So the current ratio tells you if the company is managed well. If you have a low ratio below 1, this may indicate some cash problems, because that tells you that what they owe within 1 year is less than the assets, the assets that can be turned into cash within 1 year. Interestingly, a high ratio might indicate they've got too much working capital or too much cash. If you've got loads of cash in the bank and have a very high ratio, then maybe that could be better used elsewhere. That cash could be invested in the business. So the current ratio will rise as you top up your current assets. As the business gets more cash or receivables or inventory, then your current ratio will rise. The next one is the acid test ratio, or the quick ratio. And so this involves liquid assets divided by current liabilities, remembering that liquid assets don't include stocks. So current assets minus stocks gives you the liquid assets. So we're not including stocks here, we're just using cash and receivables. So let's imagine the business has liquid assets, cash and receivables of 5.6 million, and they owe 3.7 million. So the acid test ratio with 1.5 to 1, or 1.5, which means for every £1 they owe, they have to repay within a year, they have £1.50 worth of liquid assets. So cash or money owed from debtors. Again, how might we evaluate this? Well, really it's saying this is the acid test. Will the business have any liquidity problems? Does it have enough working capital? Does it have enough cash to avoid any problems paying off its debts over the next year? So it's really a key test for a business's liquidity. So it's a good warning sign of any problems that might be arising for businesses, particularly businesses that usually hold stocks, because we're not including stocks in our calculation. Significantly less than 1, often bad news. You've got lots of debts to pay back within the next year and not much cash to do it. So again, that could be a problem. So if you turn through stock quite quickly, you get through your stock very regularly, that might not be a problem as much. Importantly though, look at the trend. Is the ratio going down over time? And if so, it could indicate there's a liquidity problem that could be surfacing soon. Let's have a look at some examples here. So here we have a statement of financial position for a business. They have non-current assets here, and then they have their current assets listed, inventories or stock, receivables or debtors, cash, and so these are their total current assets. Then they have current liabilities, non-current liabilities, money they owe. So again, the net assets here, the assets minus the liabilities, 11,235, which is the same as the shareholders' funds, 11,235. So let's say what might be the current ratio. Well, the current ratio is the current assets divided by, or in relation to, the current liabilities. So in this example, the current assets 5845 divided by the current liabilities 8160 gives us a ratio of 0.716 to 1. So for every £1 the business owes, it owns 72 pence in current assets. Is this a good thing? I'll let you think about that for a second. The second ratio is the asset test ratio. Here we look at liquid assets compared to current liabilities. So liquid assets were the current assets but not including the stock. So it's just the receivables and the cash, and that as a ratio against current liabilities. So here we have 0.425 for 1, which means for every £1 the business owes in terms of current liabilities owes in the next year, they have 43 pence in terms of cash and receivables to cover it. Again, is that good for the business? Well, here in terms of the current ratio and the asset test ratio, this would indicate that the business might have significant liquidity problems in the future, because the amount of money they have to cover what they owe is lower. They've got ratios less than 1 in both situations, which means they don't have as many assets that can be turned into cash within the next year to cover what they owe. Both these ratios indicate that there are going to be liquidity problems for this business, and they would need to consider doing something about it. Okay, we've looked at liquidity and the two liquidity ratios. The last part of this is to look at what's known as working capital. Working capital is the amount of money needed to pay for the day-to-day trading of a business. So every business will keep some cash aside, which allows them to pay and to continue to trade from day to day. And that money that they use is called working capital. So working capital is cash they have in the business, and we can calculate it by looking at the current assets that they have and subtract the current liabilities. So what do they have that can be turned into cash within a year, subtract what they owe within a year, and the difference is how much money they're likely to be able to use to trade from day to day, meet their day-to-day expenses and debts. Now, why is working capital important? Why is it important that business has working capital, has some cash it can use from day to day? Is because of the working capital cycle, the typical ways in which cash flow around a business. Let's consider the cycle for a normal business. Now, first of all, a business will order stock from a supplier. Yep. Then it will take that stock and turn it into products through the process of production. Now, these two steps will normally involve cash outflows paid to suppliers and employees. Suppliers for the inventories and suppliers to employees to produce. So the outflows have gone out fairly early on. Then what happens? We have our finished product, and that will sit on our shelves until a customer arrives and we sell it to them. Then the product is sold to the customer, then the customer pays for their purchase, and then finally we receive the cash inflow. But if you look at the cycle, the outflows have gone out first and the inflows have come in later. So there's a short period of time, or potentially a period of time, where we've paid out but we haven't seen the money in. So we need to have some working capital. We need to have some cash to start with so that we can meet these outflows. So working capital is important because stock is purchased and paid for, then turned into products that may sit on the shelf for up to 3 months. Then the stock is sold, and if we allow our customers maybe 2 months to pay, then finally we get the money in. But the cycle here would be 5 months long. Money has gone out and we've waited 5 months for money to come in. So it's important the business has working capital, some cash available to meet the everyday expenses, to keep the business operating throughout the working capital or the cash flow cycle. So managing working capital is important, and to ensure the business has good working capital, they really need to focus on 3 areas: their stocks, their creditors, and their debtors. So in terms of stock is really cash tied up in raw materials work in progress and finished goods. So the business needs to consider how much stock should it stock at any given time. How much stock should they have? Too much and you've tied up all your cash, too few and you haven't got enough products to sell. The second thing to consider is debtors, amount owed by customers. How can they chase these customers up? How can they maybe shorten the length of time they're allowing customers to pay, when one of the key features customers might like is that they have a long time to pay? So there's something the business can consider doing on debtors. The last one is creditors. Amounts of money the business has to pay out to suppliers. Maybe they could try and extend how long it takes them to pay suppliers so that they narrow the gap between paying cash out and receiving the cash in. All of these would be good ways in which the business could manage their working capital, or things to consider when thinking about managing working capital. So working capital can lead to cash flow problems. And there are a number of causes of cash flow problems. If the business is making a low profit or even losses, ultimately that will have an impact on their cash flow. If the business has maybe invested too much in capacity or is producing too much, then that can cause a cash flow problem. All the money is tied up in the production and not available there to meet day-to-day expenses. If the business has too much stock, as we've discussed, that can cause a cash flow problem. Allowing customers too much credit, having too many debtors, can cause a cash flow problem. Overtrading, growing the business too fast. As you grow and increase how much you produce, you pay greater and greater and greater outflows, but you're waiting for the inflows. So every time you need more working capital to grow the business. So that can cause a cash flow problem. Unexpected changes in the business, events outside their control. And lastly, a lot of businesses that need large working capital are businesses with seasonal demand. They need to have lots of working capital so they can pay out and accrue stock in the off-season. For a sort of surf company, through the winter they'd be paying out money, building up their stock, and then in the summer they get the cash inflow back in. But during that period in the winter they would need high levels of working capital, or maybe have a cash flow problem. The last thing is, what can they do to improve the cash position? Well, maybe they could reduce the level of current assets. That might improve their position, or maybe increase the current liabilities by delaying the payments that they're making to creditors. They could perhaps sell some of their surplus fixed assets to generate cash. These would all produce cash. Not having stock, not having debtors, delaying payments, delaying your having more creditors. In the long term, maybe raising more cash from shareholders, or maybe more long-term liabilities, taking out bank loans, or cutting back on planned investment, would all be ways of improving your cash position in the long term. So in this video we've looked at statement of financial position, liquidity and how we can measure how liquidity, level of liquidity in the business, and the last thing is working capital. That's it. Thank you. Goodbye.